A warm welcome to all our viewers. So this is the 13th week. We are discussing about fundamental and technical analysis training. And this is the fourth session. We are going to discuss about chart patterns. So we have discussed a lot about chart patterns. And this week also we have our specialist, Mr. Saliya to take you through. Saliya, over to you.
Thank you, Charitha. Welcome all of you. Good evening. And I hope the sessions that we had earlier on, including last week's triangle pattern session, some of you all have made use of it, and that is something that is really nice to know when we are learning and putting them into practice. You harness the benefit of whatever the knowledge that you acquire. In the case of today's session, what we are going to talk about will be in line with the patterns, or rather the triangles. And last week we touched on the ascending triangles, but not in detail. Today I'm covering the ascending and the descending triangles, and also the flag and the pennant. In the case of the ascending triangle, there has to be a trend. Then you need to have the top horizontal line, then the lower ascending trend line. Also, we need to understand the duration, the volume, then the throwback, which is known as return to the breakout, and the target, and how we apply the target when we develop the triangle. In the case of the trend, as we last time described, we need to first understand a trend. Now, always we will be talking about higher lows and higher highs, mainly due to the fact that when we look at charts, as I mentioned earlier, that we need to understand whether the uptrend comprises of higher lows and higher highs, the downtrend comprises of whatever the downtrend that we look at comprise. Sorry about it. Let's go to the chart. Okay, so in the case of the trend, we know that it's in an uptrend. And then the next thing in the ascending triangle, not only the ascending triangle, mind you, when we are drawing triangles, we need not only the triangles, we always, when we are using the trend lines, let me put it that way, we always must remember that when we are joining the highs and drawing that trend line, that is called the resistance line. Okay, and when we are using the lows and joining them with a line, that is called the support line. So in a trend line, in a triangle pattern, you have the support and the resistance lines. In the case of the triangle pattern, you can see that the top horizontal line, which is the resistance line, must at least touch two highs. It says at least two highs are required to form the top horizontal line. The highs do not have to be exact, but they should be within reasonable proximity of each other. But in this case, where I have drawn this horizontal line, let me draw that again by using the line here. I'm making use of the high here, which is at 5190, and the high here. What I'm going to do is I will be drawing the line and then go to the format, go to the coordinates and make it 5190. When you have a value like 5190, and if you see that there are touch points at 52, you can even change to 52 because it's a psychological area. But I'm taking the 5190 because I like to keep it that way. So this is the trend line, which is the horizontal line. The guidelines are telling us, and at the same time, you can now in this instance you can see that these two minimum points are at the same levels at 5190, and here also 5190. But according to the guidelines, you can even use this and make it a horizontal. Ascending triangle chart, and make this the horizontal line. But here I'm taking the 5190 as the value and drawing the horizontal line this way. Thereafter, you have the lower ascending trend line. So the support line is ascending, ascending with the joining of the lows here. And here it says at least two lows are required to form the lower ascending trend line. So you have, this is how you do that. First you pick one low like this, and then you can either pick this line or rather this low or this low. In my case, I'm taking this low and extending it this way. Now, certain instances, some chartists, they used to take only the body, right? They do stay away from using the shadows up and down, right? But in my case, the reason why I am using the shadows is because I value the range. Range starts from the low to the high. This is the full range. If I'm taking the body, I'll be taking the range or the extent between the close and the open, right? So when we are, we can make use of that, but that does not necessarily mean that we can't use the high and the low range, or the range between the high and the low. So in my case, I'm using the lows and extending the trend line, which is ascending, by joining the higher lows. Thereafter, this is very important. We need to understand that the duration, the length of the pattern can range from few weeks to many months, with the average pattern lasting from 1 to 3 months. So an ascending triangle need not be a short-term triangle, right? It can vary or stretch out from 1 to 3 months, right? So if you see the triangle formation, or if you can spot that when you're analyzing it, if you spot the triangle where the highs are always within a month or within 3 months, if you see that the highs are testing a certain level continuously, right? That can last for from 1 to 3 months. The other thing is the volumes. Just like the previous symmetrical triangle, first the volumes. Now here, as you can see, I'm not using this range, but I'm only taking this area. If you look at this area, right, even though these volumes are not as high compared to this level, that is because of this impulsive aggressive move here, right? Over here, if you take there is, compared to the rest of the volumes, there is an increase in the volume when this the stock started extending up from this level. Thereafter, when the reversal or the pullback took place, the volume started coming down, and you can see that while the prices were moving, you can see that at certain instances, of course, because at this range, when the prices started increasing again, we can see the volumes building up, starting from here in this uptrend, right? The volumes were building up, and then again moving down along with this movement. Now remember, an ascending triangle is a continuation pattern, meaning if you have identified an uptrend, an ascending triangle, a perfect ascending triangle is a pause and will resume once that pause is over. So for the pause to be over, those pauses are called the consolidations, as we have been describing, right? At any given moment, that level at which point the consolidation takes place, you will see the accumulation and the distribution happening. The buyers and the sellers exchanging with each other. So if the uptrend is intact, then the buyers will rule the day, and you will see that the trend resumption after the consolidation is going to happen. When that resumes, when the trend resumes, ideally this type of volume behavior is ideal, right? The volume behavior is important, not really important, but it will be ideal. Why I'm saying it's not important, it's because of the ascending triangle. In certain instances, based on the guidelines that I have given here, incidentally, these are the guidelines as per international standards. That's why I thought I should be sharing them with you. And I have taken this from one of the famous sites called Stock Chart School. So there you can see if you visit, you can look at refer to so many other subject areas regarding technical analysis. So based on the guidelines, it is not so necessary to see that the volumes are increasing along with the breakout, but we need to understand the mechanism inside, or the play that is there inside a breakout up or down, right? For a stock to go up, the price alone cannot move that stock to a certain level, right? It happens especially when you are within a consolidation, when you are within a tight horizontal range, right? That can happen at that point. If you look at these levels, if you just if you are interested now to start going into detail of how the structures are happening, then you can always spend time and understand how this is happening. Now here you can see that these moves that we can see here, which is obviously having higher lows and higher highs and moving up, but relatively the prices, the volumes are not as high as the volumes that are given here, or that are given here, or that are given here, right? So within a channel or within a consolidation where the support and the resistance is always being respected, and the prices reject either the support and the resistance levels, you don't see too much of volumes changing hands. But now here, there had been a strong resistance area for a period of time. If you take, if you start from this resistance level and move on up until this breakout, you can see that it has lasted 95 market days, right? So it's a pretty long, frustrating journey for this for this counter, right? So when you see a thing like that, when you see a side, a very strong resistance like that, right? We need to understand that without stronger participation, right? Uh, the resistance cannot be broken. And that's exactly what happened here, right? You can see that it tried to move above the resistance area during these particular days, even here, but it was not successful. Thereafter, we can see that there is a breakout with a higher range. Now, in this instance, that is on the 2nd of September, the range was between a low of 51.20 to a high of 56 rupees. So it's a fairly long range within which we can see a volume of almost 4.6 million shares had changed hands along. So, you know, that type of volume was needed, and that kind of a range was needed for that aggressive breakout to take place, right? Thereafter, we can see that there is a thing called return to breakout. When the horizontal resistance line of the ascending triangle is broken, it turns into support. Sometimes there will be a return to this support level before the move begins in earnest, right? So as you know, this was the resistance line. The moment the price breaks, this becomes the support line, and 51.90 area will be the support area. Okay. As such, what happens is it goes up in certain instances, not always. It throws back to test that area. And you can see that after hitting a high here on the 7th of September, the prices have fallen along with the market sentiment. And today you can see that it has almost tested that 51.90 area when it came down to 52 rupees and 50 cents, and then aggressively moved and closed at 55.80, just like many stocks performed today. So this is a throwback, and at the same time you can see that there is a throwback here, but this throwback is you know, within the channel or within that triangle area, not that it came and retested the resistance turn support area, but here it has happened like that. Then what about the target? The target normally is the distance, the longest distance in the triangle, and the longest distance is this. I prefer to take this because I'm using this bottom as the first. I'm not taking this as the first, but you can always make use of this bottom as well, where you draw the triangle starting from here. But in my case, I'm taking this range. Therefore, I'm using this distance like this. You can do this. Or also, you can make use of the line and just draw the line like that. Let's color it red. Now we go to this price range, clone it, and it says to drop it at the breakout point like this. Once the breakout has occurred, the price projection is found by measuring the widest distance of the pattern and applying it to the resistance breakout. So you go there and apply it there. And the projected or the expected level would have been about 62.40, 62 rupees and 40 cents. Now this one also, if you are using only the line instead of the price range, you can clone it. You go there, you get the same value like that. Okay, so that is how we make use of the ascending triangle. So the idea here is to what is happening here is that, you know, when the prices go up, everybody wants the price to continuously go up. That won't happen always, right? At the same time, when the prices are falling also, it is not going to just keep falling. There are instances where the prices, the demand side or the accumulators of the stock, right, will try to buy as low as possible, at which point the sellers are coming in and giving to the buyer or to the buyers. Thereafter, the demand and the supply comes into play, and there is a sentiment that's automatically, inherently getting created, where the buyers find that the sellers are not coming into the bid side mostly. Instead of that, the buyers see that the buyers are moving into the ask side and clearing the board. So when the sellers, the ask side sellers and the bid side buyers feel that the prices are little by little increasing, the lows are increasing, right? In turn, it becomes a premium compared to the previous day or the previous period. Along with that, automatically, the lows are increasing. That's because the supply side is not giving at the previous low levels. When that takes place only, we see this formation happening, right? These are not these candles that we see here, as we know, are not just created by thin air or out of thin air. It's all created by the moment that the legitimate transaction has taken place, right? All these prices, all these ranges between 50 to 58 rupees, these are legal prices that had got traded in the stock exchange and got confirmed. You know, the moment that the transaction happens, it's a confirmed order. So all these values that are given here in terms of the range or the open and the close, they are all legal prices. They are not, you know, whimsical prices, right? So now here in this instance, what happens is those prices, the real prices, are what is increasing, right? Therefore, we need to understand what is happening inside. That is why we call this price action. Action inside the price. Now the price won't go up and down in isolation. You know, when you're buying, you pay a price to buy a number of shares. So that's what is happening, shown here. These are the numbers of shares that are being legally transacted every day or for that particular period, right? So these are all legal data that we use to analyze these formations, right? So when you see, that's why, I mean, I'm trying to sort of explain the reality or the real-time picture that's happening in the market for us to see a formation of this nature, right? So that's why this is called an ascending triangle, right? You have the ascending triangle. I didn't cover the rectangle or the sideways channel, but you know, if it is sideways channel, what happens is it's something similar to this, where this low and this low almost similar. So I mean, if we take something like this, where I'm joining only these 2 points, right? This is a channel, right? So the idea here is to trade within the channel, right? And there again, a breakout will happen only with an aggressive move, which is also known as an impulsive move, right? So that is as far as the ascending triangle is concerned, right? So then we are moving on to the next pattern, which is the opposite of the ascending triangle, which is called the descending triangle. Now, in the case of the descending triangle, the same thing, the opposite direction is happening, right? The trend. Now, trend has to be following the pattern. In other words, this established trend that should exist has to be, in the case of the ascending triangle, has to be an uptrending formation. But, when it comes to consolidations, it doesn't matter, especially when you're looking at the ascending and the descending triangle formations. The trend itself is not the important criteria, because by now you would have not realized that it is the demand and the supply play that makes that ascending triangle happening. So even in a downtrend, if there is going to be an ascending triangle, which means the demand is paying premiums. Similarly, in the case of the descending triangle, the supply is discounting, meaning there are two lines, the support and the resistance line. But in the case of the descending triangle, as you can see here, the bottom horizontal line must have at least two lows required to form the bottom horizontal line, right? So in this instance, what I'm going to use will be this level. This area that's around 970, right? Then I'm going to draw a horizontal line at 970. Like that. So our minimum requirement is fulfilled, where minimum of 2 points or two lows have to be there to draw this line, right? Thereafter, it's the upper descending trend line. At least two highs are required to form the upper descending trend line. Okay. So what I'm going to do is I'm going to use this line, or rather this high and this high, or even this high, because as far as we are covering two highs, that is the minimum standard, right? So we are going to take this high and this high. Right. So now this is a descending triangle where the sellers are discounting, right? The selling side, now sellers are realizing that the buyers are not coming into executing orders onto the ask side. So they invariably start selling into the bid side. And at the same time, even if they want to sell at a higher price, it is the importance, or it is the due, or the working of the bid side that is at play here. So basically, the buyers are in control, where the sellers are reluctantly compelled to start unloading or selling down to the buy side. And along with that, you see the descending highs where the prices, the high values are coming down, making lower highs, whereas the lows are going sideways at 970 here. Right now, today you can see that it broke below that level. Now, you might remember when I described the volume behavior in the ascending triangle, right? I mentioned that the volume was not the main criteria, right? Volume is important, especially when that resistance is very, very strong. If there is a strong resistance, where the ask side and even the outside sellers who are willing to sell at those respective prices have a lot of selling to do, then you need a lot of buying power to break that resistance out. But in the case of the descending triangle, sometimes when there is more selling pressure, right, it is natural that the buyers would want to stay away, right? That's one of the classic examples that we saw today. And starting from last Friday, we saw many buyers opting out for discounts, whereas the sellers were desperate to sell. Today it became very aggressive. So here with that aggression, even East West had a small volume comparatively of 48,000 changing hands at a lower price, lower than 9 rupees and 70 cents, making a breakout below the support. So this is the descending triangle, and the projection, just like what we did in the ascending triangle, we take the longest range and project it downwards, right? So I'm using the price range. This is the longest range. I'll be cloning that and bringing it to the support line. So based on the expectations of this descending triangle projection, the stock can come down to around 780 or 790. There is a chance that the stock can come down to 790 if this this formation here, today's formation, where you can see that it opened at 9 rupees and 80 cents, came down to 920, and then closed at 950, right? So this is also known as a hammer form, a candle called hammer. But at the same time, we can see that, I mean, just like the ascending triangle, there can be a throwback or retesting the support before an aggressive or a quick extension of the drop. Before that, there can be a retesting of the support that can happen. So the target is given like this. A retest can happen where it can go up to 970, test that level and come down. Or you see, just because you have the triangle doesn't mean that the prices have to come down, right? That's why we have two lines, the support and the resistance line. And the stock can trade within that triangle itself, right? So we need to always remember the moment the price, let's say it throws back or rather moves up to test the support line, and then it closes above the support line, then the price will go into this triangle zone. At the same time, it doesn't mean that the prices are going to go up. The price will go up, rejecting this descending triangle only when there is a breakout, at least from the resistance line, which is the descending line, right? So then it will be a rejection of the triangle pattern. It applies to any triangle pattern. It applies to any support or resistance line. It happens to all the patterns, right? At one given moment, if the change of events takes place, the demand is stronger than the supply, right? If the downtrend is at play right now, it can change, right? So that is why you have waves up and down, right? So when we are looking at waves, we will understand, if we remember the basics of higher lows and higher highs, lower highs and the lower lows, then we understand whether there is going to be a reversal at which point. So that is regarding the descending triangle. Then the next two types of patterns are the flags and the pennants. This is pretty interesting, especially when we are enjoying an uptrend. You know, the reason as to why it is interesting is because, you know, to be considered a continuation pattern, now this flag and the pennants are called continuation patterns. There are bullish flags and bullish pennants, or bearish flags and bearish pennants. I'm going to explain only the bearish flags and the bearish pennants because that will be relevant to us. Now, when it comes to the move, it has to be a sharp move, right? The flags and the pennants require evidence of a sharp advance or decline, right? So what that sharp move means is that there has to be an aggressive long candles forming at different time periods. Now I'm using a 1 hour chart purely because it is easy to figure those flags, flag and the pennant patterns. Then in the case of the flags and the pennants, you can see that, you know, this is almost like a flag, but not so much. It can be something like a wedge also, but it's almost similar to a flag here. Then you have a triangle, symmetrical triangle formation here. Then a decent channel, downward sloping channel, which is also can be considered a flag. Here you can see an upward channel, right? Now these are in isolation also, we can make use of them. The difference between these channels or triangles, symmetrical triangles in isolation and in flags are purely the duration. It's to do with the duration, right? So these flags and pennants are short term compared to the symmetrical triangles and the other ascending and descending triangles. You can see here, flag and pennants are short-term patterns that can last from 1 to 12 weeks, right? Now, that does not necessarily mean that it has to last, you know, at least a week. That is not the point. That's why I'm using the 1 hour chart, right? These are short-term or very short patterns, right? Things can happen aggressively by using this, you know, very aggressive moves. The moment there is an aggressive move, you can see a consolidation taking place, a pullback happening, right? So that can last only a few, maybe hours, maybe even few days, or we stretch out to these, you know, like 1 to 12 weeks. So obviously the other patterns, the symmetrical triangle and the ascending and descending triangles are duration wise has to be longer than that. So in this instance, as I mentioned, the two differences between the flag and the pennant are the channels and the triangles. When you see a triangle like this, it is called a pennant. When you see a channel like this, it is called a flag. For the pennant and the flag to be complete, then you need the pole. This is the pole. And the pole is that aggressive move, which is also known, as I mentioned earlier, the impulsive move, right? It may not be clear, but I'll just show you the day chart and you might see what I'm talking about, right? You can see that these two are very aggressive days, and then it goes into another 2 days of a sideways movement. Then again, there's a breakout, goes up, moves into a sideways movement. Breakout, moves into a sideways movement. Breakout, moves into a sideways movement, right? That's why these are called poles. Sometimes these poles can be much longer in size, right? If we, so basically we need to understand that. Then the break, right? For a bullish flag, the bullish flag has to be taking a bullish flag. Now this is a bullish flag. Before that, let's look at the guideline for the flagpole. For the flagpole, starting from here, let's say, if it is a bullish flag or a pennant, the starting point of the pole will be the breakout of the previous resistance line. Now this is the previous resistance line, right? Joining this high and this high. So there is a breakout of, the price broke out. So from here only it starts. So when this aggressive move takes place, this becomes the pole. Then the sideway movement, we can measure or analyze. And if it is almost like a channel, it is known as a flag. If it is a triangle formation, it is known as a pennant, right? So that's basically what it means. Then the projection, or rather the target. At the same time, the volume, if you take, the volume for the, especially for the pole, has to be very large in size. And obviously we know how Expo Lanka was trading, with very large volume. So it was not a very hard thing to find out and figure out the flags and the pennants in this counter, right? So you can see that all these are very aggressive moves, right? Here also you can see the same scenario, and also here, right? So when there is an aggressive breakout with large volumes, that is creating the pole. Now, for the target, we will be using the range from that breakout point to the end, or to the pause of that uptrend, which moves into a resistance, right? So that area is what we are taking. We can take it this way, and we can project it by taking it up to this level, this point. You can see that the price managed to go a little bit higher than this. But if you know how this is forming, you can place a breakout, place a buy stop limit order and get into this counter. And at the same time, you can have a GTC limit order by identifying the price where it can go up to. In technical analysis, this is the only place where we decide on targets. Unfortunately, when the markets are rising and really at play, a lot of people are not interested in that. They want the maximum, right? And today, a lot of people would have learned a bitter lesson, right? Basically, it was like a very strong message given to those who are not applying any type of principle, money management theories, disciplines, and so on and so forth. So this is how, now this is the projection for that. For this flag, if you take for this pennant, we will be able to go up to that level, take it up here for the next breakout. Again, there was an opportunity. Then if you take this, stretch it up to this level, then you had another opportunity. So basically, in a matter of from August 13th or 16th up to 1st of September, you had one, meaning you buy, a breakout buy here and a sell here, breakout buy here and a sell here, breakout buy here and a sell here. So basically three trades would have made that amount of money. You can see this is 28%, whereas whereas this level was another 28%. %, right? So you had 25% here, 28% here, 28% here, right? So if somebody is interested in following technical analysis the correct way, right? You have opportunities to grab, which in turn is much more satisfying than just placing your funds in a bank. So if you can learn this the right way, apply it in good faith, right? It is not anyone else but we who are going to rejoice. So those are the three or the four types of chart patterns we have for you today. And if you all have any questions to ask, this is the time. Or otherwise, I'll just hand over the session back to Charitha. Thank you very much. See,
so thank you very much, Saliya. So we do have one question. What is it? So Rohita is asking, what is the target for Expo?
As far as the target is concerned, what happens is right now, okay, today it closed. Give me a second. It closed with a hammer, meaning